Now, interestingly enough, in our prior example, we didn't address any profits or didn't even look at whether there were any profits generated prior to 2016. The IRS does allow companies that generated operating profits up to 2 years prior to the NOL period to apply the NOLs against the 2 prior years' profits. In that case, if there were in the last 2 years prior to the 2016 year, had there been profits, the IRS actually would issue a tax refund in 2016. Now, this is a choice. Companies don't have to carry back when they generate NOLs. They can elect to waive the carryback option and only carry forward. Now, since companies generally prefer cash up front, this waiver is usually only made in the event that future tax rates are expected to be higher than historical tax rates. Because, of course, if you had much higher tax rates in the past, you would be shielded from much more in taxes because the NOLs are what actually are being used to offset the tax liability. So let's go through an example that shows that. If we revisit our example, but also identify that in the past 2 years there were some NOLs, and let's say the company chose to carry back instead of carry forward, what would happen in this year was very different. So the year that we generate the 400 in NOLs, you actually create no deferred tax assets. Why? Because there are enough profits in the past 2 years to fully get a refund of $160 million immediately, rather than waiting and hoping that you're going to generate profits down the road to be shielded from. So what would happen here is the company would say, hey, they always start with the 2 years instead of the 1 year back. They always go 2 years because that's the one that's going to expire immediately if you don't use it. So you say, okay, let me go back to the 300 year. I generate 300 million in profits. I can use the 400 million in NOLs that I just created to offset tax obligations associated with $300 million in profits generated in 2014. So the IRS, I paid $120 million that year. So the IRS is going to cut me a refund today for $120 million associated with the 2014 profits. But I have another $100 million in NOLs left. So I go back to 2015 and I say, do I have enough NOLs to get any sort of refund for this year? And the answer is yes. I have $100 million in NOLs left, and at a 40% tax rate, that implies that I'm owed an extra $40 million in refunds. So the 120 from 2014, 2015, another 40 gets me to the 160. Interestingly enough, had I had any losses in 2017, note that I could still use up 200 of the 2015 NOLs. I still have, the 2015 net operating profits. If I had losses here, I could still, and I chose the carryback, I could still go and carry back. The deferred tax asset from NOLs is reduced as the company applies NOLs, as we just saw, in subsequent years against operating profit and records deferred tax expense. One other accounting concept that we should introduce is the concept of valuation allowance. Up till now in our exercises, we talked about how we assume that the company will generate sufficient profits in the next 20 years to be able to benefit from all those NOLs in the future. Now, if the company expects that it will not generate sufficient profits within the next 20-year period to fully benefit from all those huge NOLs potentially, imagine a company generating massive amounts of losses and not really expecting being able to generate enough profits to make up for all the losses that they've had in the past, they actually have to write down the deferred tax asset to recognize that it's not worth what we originally thought. If we don't foresee sufficient profits to fully take advantage of all those net operating losses, we got to write down the DTA. More precisely, the accounting for it involves the recording of a credit within the deferred tax asset contra account called valuation allowance.